breaking news for your home. Wayday! Wayfair's big sale is almost here, and you can score the best deals in home. Like up to 80% off everything home. Yes, you heard that right. 80% off with free shipping on everything. Plus surprise flash deals all Wayday long. We're talking outdoor furniture and essentials, rugs, and more. All at Wayfair, and all up to 80% off during Wayday. Shop Wayfair's Wayday from April 25th through 27th.
Wayfair, every style, every home.
This is the 0 Days to Expiration podcast on YouTube, on X, and then you can also listen to it on Apple, Spotify, Amazon Music, and I think a bunch of other places too. Every week, Monday, Tuesday, and Wednesday, we do a series of these podcasts, these presentations, where I talk about various aspects of zero DTE trading, and in particular, our style of zero DTE trading, where we take extreme asymmetric positions. That means we take tiny little risks for a large potential reward for a very good reason. We're trying to catch convexity in that trade. And what is convexity? That is really, and you're going to see this later on in this presentation, that is really the place where the cost of your trade starts changing dramatically from relatively costly to super cheap. But the optionality and the opportunity doesn't change all that much, and that's where we play. So in other words, we're getting super cheap for great return on the risk that we're taking. So risk-adjusted returns is everything that we're about. So we're going to start off today with what we do every morning, and that's take a look at our morning routine and how the trades are going to set up for today. But today's presentation is titled, Take It or Let It Cook. In other words, should we hold or should we fold a trade? And what is exactly our profit-taking strategy? But first, let's do what we normally do, and that's take a look at the market. And we're going to right-size our trades and figure out where the entry levels are and determine our direction. I think the direction's pretty well established right now that we're in a bull market, and so we're going to be looking at out-of-the-money call flies. Now it's just a matter of looking at the VIX and seeing where that is, which has dropped dramatically. Let me get over to that right now. Let's see, am I going to go there? Nope, that's not it. Let's go to Trading View. There we go. So we see that I've split up the VIX into regimes, Zombieland, Goldilocks, Chaos. We've dropped almost down into Zombieland. We're right on the precipice. Yeah, let's see, about, 17 and change. That determines the level of premium decay or the rate of premium decay for that trading session. And from that premium decay, we can infer that there's a relative amount of risk and profit potential. And also how it's going to fashion itself over the course of a day, which is another point you'll see in this presentation. In any event, it looks like we're about 30 wide this morning. I suppose if you want to, you can go to 25 wide, but 30 wide, I think, is a good number for this morning. We are bullish, so we're going to do a call fly, so we know our width, we know our direction, and now all we need to find out is our entry event and where that is going to be based on market structure. Now, I haven't updated the market structure here since this move up, but we'll do that very quickly. And so what I'm going to do is I'm just going to draw in some lines here, and they're going to indicate the extreme change in volume and or lack of volume, the levels of incidence on the volume profile, and that will determine where support and resistance are going to be for that day. So I'm going to just put in a few lines. I'm going to make them all yellow for now. And then we'll zoom in to see exactly where they lay. And then one right here. And then one at the top of the market. We're almost there. All right, now let's zoom in. Hold on. This is the wife. She's in Italy. Can't talk. Call me back in about an hour. I'm doing my show right now. I know. Okay. Bye, hon. All right. Bye. Yeah. I just brought it to the airport yesterday. She's in Italy. She got confused about what the time was. So there we go. I'll talk to her right after this. And all right, we're zooming into a 5-minute chart because that's our daily time frame. And you can see where our lines are that we drew in here. We don't need the volume profile anymore because we have created our structural levels. The next thing we'll do is just identify where the market is or where it starts, the sessions. So here's where the market will open, which will just be in a few minutes. Our morning session is from 9:30 to 12:30, and our afternoon session is 12:30 to 2:30, and then our closing session is from 2:30 to close. All right, and we just like to mark that up. Okay, pretty wide. It's not a lot going on up here. So what we're looking for is a pullback into structure. So what that will likely be is a move into here, and then that's our trading event, and then we'll look to move up, right? Something like that. Or we could break out up here and then come back down to here, and then that would be our trading event. Let's see what it looks like a little further up. There are other opportunities up here. So that's what we're looking for, and it could, in fact, come up to here as well. And we could find another possible trading event right here. So that's what we're looking for. We're looking for a pullback into structure, and that will define our trading event. And when that happens, we'll put on our out of the money fly, giving our risk to reward, which is typically about 5 to 10%. The debit will be 5 to 10% of the width of the fly. So for a 30 wide fly, that would be anywhere from $1.50 to $3. So that will place the fly where it needs to go. All right. Glad we got that out of the way, and now it's time to go to our presentation. So I just need to switch it for me and switch it for you. Let's go back to the big head. Like I said, we're going to be talking about our profit management strategy. This presentation is super dense in the content. Everything that I'm showing you here has been determined by thousands and thousands of trades, so it's empirical evidence, as well as the options math, the geometry and the physics of options decay. This is a professional way of trading. It's not a simple pattern or whatever it is. It is a dynamic profit management system. But once you understand the basics of it, it should all make sense no matter what situation you're in. You just have to know how to adjust that dynamicism according to the market structure and the market level of volatility and your gamma and all this other stuff. I'm going to lay down the concepts and then we'll get to it. All right. Hey, if you like this type of content, give this video a thumbs up. If you're listening to this on Apple or Amazon or Spotify, please go down and give us a review. Really appreciate it. And if you do have comments during the show, please put them in the comment section. I read them all. Good morning, James. And Jerry is there. Coach, can you share the exact words to insert how to participate in the Monday through Tuesday and Wednesday 9:15? Oh, okay. Yes. So to participate, you just go to the video, go to my YouTube channel, which is at 0DT. It's the YouTube at 0DTE. You'll see every week it'll show the Monday through Wednesday show at 9:15 every week. All right. So Hugo, good morning. Rick, good morning. Please, if you're here, just say hello, or if you have a question. But I'm going to get into the presentation right now. There's a lot to go to. I think we have over 20 slides, so I'll do my best to get through it. All right. On to the show. Let's see. PowerPoint. Take it or let it cook. Hold or fold. That's what it's all about. And here's the basic thing. Although we are discretionary traders, whether you hold or fold isn't just a matter of your opinion. It is really what the situation is. And so we're going to go through some very exacting things about how you manage a trade. Now, all of our trades are out of the money butterflies. We put them way out of the money, typically with extreme risk to reward. So what that means is small risk, large potential reward. That results in very low drawdowns, ease of management, And you'll also see a really great benefit to doing that in terms of your psychology and trade management a little later in this. All right. So here's the key to all of that. Because we're taking such small profit, we're not really managing risk like you would normally do in some of your other trading methodologies. In fact, in other trading methodologies, that's all you do. Everything revolves around managing risk. That is the reality. And necessarily so, because you're taking such huge risk for the amount of profit that you're going after that you're compelled to do it. And so you're always managing your risk, and that exerts a certain amount of anxiety and affects the psychology of a trade, resulting in less desirable situation for you making decisions. So we do something very different. And by doing it this way and focusing on profit management, a completely different mindset, we're focusing on the positive than the negative. Calm replaces fear. It's now we're on offense, not defense. Patience becomes possible. That's the other thing. Everyone says, oh, you got to be a patient trader, you got to be disciplined, but the market is bombarding you and you're just totally under the gun with that huge risk pending, right? It's hard to be patient in that kind of situation. With our strategy, it's super easy. We never sweat any trade. If it goes against us, no big deal. It's only a very small percentage of our trading capital. Big, huge difference there. All right. Now, here's the other big change. Everyone is focused on that expected move. They want to place their trade within that expected move in order to gain some kind of advantage, that they will be closer to the money, that they have some level of confidence that the market will stay within there and then pay them off. But soon you're going to see why that expected move is a canard and a little bit of a lie, and why you're cheating yourself by looking at the expected move. I said that you are absolutely cheating yourself by playing the expected move and placing trades inside of it. All right? But that's where the majority of those moves are. Outside the expected move in these orange areas, that's where you're going to find cheap convex trades that have extreme asymmetry and much better risk-adjusted returns. Now, here's really the reality of it all. The blue line here that you see, the blue dashed line, is the expected move. And what you're seeing is the daily move in the market for the past several years. So expected move, that's everything in the green down below that blue dashed line. And if that's where you play, okay, so you have a higher degree of certainty getting into smaller trades, but you're never going to get the big win, ever. You're always wondering, like, how come I never get a chance at that big win? When in fact, that's all we're ever going after, is those big wins. We'll take the small wins, no doubt. In fact, they're the majority of our trades, and you'll see that soon. But our strategy allows us to get those big wins when they come because we're already positioned for it. That doesn't mean that we're going in for it every day, because it's not, from a probabilistic point of view, not the best thing. But because our strategy is geared towards it, as well as the small wins, we can take them. I'm going to spend one of these sessions in going over our trade channel in our Discord and start showing you what some people are achieving with their returns. You'll see average returns around 200, 300%, 400, 1,000%. Those are the type of returns that you're seeing in our service. If you want to see that kind of return for you, then join the service. Go down below. It's flyinthewall.ai/try and join our observer tier. It's a 4-week trial. It is a paid trial, but you can cancel anytime you want. It's super cheap, and you'll have all the benefits of the most advanced member. But then you'll see how we trade, how you're going to learn what to do. You'll get a free coach call every week, and you'll be able to talk directly to me and other experienced traders, hundreds of traders that have been doing this for years. All right, so expected move. We play outside expected move. Everybody else plays inside it. Now, that's one of the things that seems to differentiate a professional strategy from a retail strategy, because everything that the professional does seems counterintuitive to the retail trader. Just so think about that. Retail traders, Oh, 95% of them, up to 98% of them are all going to bust their account within 5 years. Oh my God. That defines the retail trader, but that's not what defines the pro. The pro is on the other side of that. All right. Why most won't go where the money is. It's because it does take a fair amount of patience, and you have to be willing to work or trade sideways for a while. But what you're not doing is you're not drawing down. That is the key. In a high probability strategy, that's the canard to it all. You're getting all these tiny little wins and they're advancing your account. Then all of a sudden, inevitably, you hit that big risk and bam, you wipe out 2, 3, 4 weeks of profit taking. And that is dejecting. In our strategy, that never happens, ever. So, no one wants to experience that discomfort. And let's say sizing correctly outside the expected move requires believing in math you can't see today. So that's something that is built into any kind of strategy that's worth its while. You need to learn it, and then you need to internalize it. You need to develop the routine, and then the process and the discipline. Doing it this way, though, it's easy because you're never really putting yourself at great risk. And so it's easy to develop those good habits. If you want to know more about habit taking, go to, I think it's 2 weeks ago, where I spent the whole week talking about building your routine. It is the secret to success in this. All right, we're moving right along. We have essentially 3 categories of strategies, and they're really based on day trading versus short-term trading. And the day trading is actually split up into kind of day and 1 or 2 days after that. There are some situations where we prefer to go 1 or 2 days out as opposed to taking the trade in that session. And that happens when we have super low volatility. As you can see, when premium decay has accelerated dramatically and we are forced to go and search for that 1 day out or 2 days out because that's where most of the premium had decayed already. And by the time we get to that 0 DTE day, there's no meat left on the bone. However, with the wider trades going from 2 to 5 days or 5 to 10 days, they're a little bit different. Now, the short-term trade is very actively managed. 0 DTE, we're very conscious of where we are in the day, what the level of volatility is, where the premium decay is, what's its profile going to look like over that course of that day. When we start going further out, the 2 to 5 day starts becoming a little bit more deterministic in terms of market structure, looking at your gamma exposure, flip zones, that sort of thing. And so it is a little less active, but still somewhat active. And then when we go a little further out, we start becoming more passive and more opportunistic. Really not doing much management at all other than waiting for that day that the strategy pays off. And when it does, we take the trade. But all of these have this one thing in common, and that is that it's extreme convexity, extreme risk to reward, very small risk, large potential reward. So none of them you have to really sweat. Okay. And this is illustrating on the scale of how active you have to be. And often what we do is traders will trade all 3 of these campaigns. The ones that are further out have very strict, deterministic periods that you trade. So, for instance, the convex stack, we're trading about 8 to 10 times a month, and they're done on specific days of your choosing, and then maybe a floater trade. And then the Sigma Drift is a little more spread out. They're done about 5 times a month, maybe 6, where you have 1 a week, you pick the day, and then 1 to 2 floater trades that you set up based on market conditions or geo-macro events, that sort of thing. But you start this trade already knowing what you're going to invest over the course of a year and when they're going to be trading. And so it's almost automatic when you put these on. But as you go further out, like I said, the profit taking is more determinist or more opportunistic, where in the short term, 0 DTE trade, as you go further to the shorter term, it becomes more managed. So one principle, tighter convexity, more management. Wider convexity, more patience. The clock dictates the cadence. I like that. All right. So now we're going to talk about when we get into a trade like this, what are your expectations? What is the distribution of returns? Now, we're 50-50 traders. When we put on a trade like this, if you determine trend and you put on a trade, you have to expect that 50% of the time it's going to go towards your strategy and 50% of the time it's not, regardless of where the trend's going. So the fact that we're choosing the trend doesn't mean that we're trying to determine what's going to happen that day. We know that it's a 50-50 shot. And that's why a lot of people will go to these market neutral trades like Iron Condor or whatever. They feel a lot more comfortable if they're in profit, at least for part of the day. They feel like they've accomplished something, except that the gamma risk and the risk to reward are just abominable. Did I say that correctly? Maybe I just made up a new word. In our case, we understand exactly what the probabilities are, how often trades will land. This is really all about distribution of returns, the normal distribution. And so we know that what percentage of opportunities are going to be in our zone 1, zone 2, and zone 3. We also know that we're not trying to get the trade inside the profit tent because that only happens about 25% of the time. If you add it up, the 10, 10, and 2.5, it's 12.5, but that's the 50% of the time that we're profiting. So that's 25% of our total trades and 12.5% of the time of all trades. I'm sorry, it's 25% of our winning trades. 75% of our winning trades are this other area, the blue area, zone 1. And that's where we can expect anywhere from a 50 to 250% return on our risk. When we get into zone 2 or zone 3, it can be as much as 1,000 or 1,500%, but generally between 250 and 700% return on our risk. And when I show you the returns from members, you'll see consistently people are getting a 200% return, a 500% return, and it'll seem surreal, but that's what we do. All right, let's go on to the next slide. We're making good progress here. All right. So what is it that we're looking for when we get into a trade? Primarily what we're looking to do is see if we're going to get into some level of profit, right? And we're trying to decide whether or not we fold or hold. And there are a number of factors that are dictating how the market's going to behave. One is the price action or the volatility. The other is the thing that we're fighting against, which is premium decay, theta, and also the sensitivity to our price, or gamma. In other words, the slope of that profit curve. And that slope is slowly getting steeper and steeper throughout the day, and the theta on the outside of the trade is negative, so it's going away, at least for part of it. It depends on where you are. You can be outside the profit curve, and while it will say negative theta for some trades, for a good portion, or at least half of those outside the profit curve, it'll actually be positive for some period of time. And so that's one of the advantages of the butterfly, that you can have positive theta, at least for the first half of the day, and still not be inside of the profit tent, which is really cool. And then, of course, there's the level of volatility, because that's going to determine our time frame over the course of the day. Low volatility is going to give us a much smaller window of opportunity, and high volatility is going to give us a much wider range of time for opportunity to take a trade or to be in the trade. So these are these three different competing things. I call it the 3 Ds of options. And it's what everybody looks at: time, price, and volatility. They result in changing theta and the theta and gamma equation. It's like volatility equals theta and gamma or something like that. But it really comes down to where and when we are, and how we make our decisions. So all of this is broken down. It is exactly broken down. So the reality here is that theta is constantly decaying or coming in, and it's coming in at an exponential rate. So the first part of the day, it's a slow thing, and we have a little bit of time to maneuver. As we get further into the day, if we're still in the trade, let me just say that in the first part of the day, most of the trades are taken off in there because we hit our risk limit and we get out with pretty decent trade. But if we stay in the trade going into the afternoon, then we're usually into a much larger trade. So outside, we're looking at anywhere from 50 to 250% return on our risk. Inside, of, or past noontime or into the afternoon session, now we're starting to look at 250, 400, 600% return on our risk or much higher. So our alertness has to go way up, our constraints and our dynamic trailing stops start shrinking at the same rate that premium is decaying, right? So now that's a lot to take in, I know. However, when you start trading this for a while and you develop that routine, it starts becoming second nature. And that's the key. So in the different volatility regimes, you also have to take into consideration, and I've already mentioned this, what that opportunity means. In low VIX, you're theta dominant. In mid VIX, these numbers aren't quite right. I would consider low VIX probably closer to 17, and this one 17 to 25, and then above 25. This is where we start changing our strategy depending on where it is and the level of opportunity that there is at various times of the day. What it really comes down to is that when you're in much lower volatility, the rate of decay of premium has accelerated dramatically, leaving less meat on the bone for you to grab. And so that means that you have to make most of your decisions earlier in the day. And then as the VIX starts rising, you have a wider range of opportunity in terms of time now across not just one session, not just the morning, but now the afternoon and possibly the closing with higher volatility. In fact, that's one of the reasons why we tend to pin trades or get those really big ones more often in high volatility. It's certainly possible in low volatility, but it happens more often in higher volatility regimes. Now, we were there for a while over the past few weeks, but now we've dropped down and we're entering zombie land. So we're switching our attitude and the level of attentiveness and urgency in taking profit in low volatility. Here's another thing that's almost exactly the opposite from a retail trader. They think that low volatility is good, but it isn't. It's from a pro trader's point of view, it is much more difficult. You have higher gamma or higher sensitivity to price. You have to trade smaller, and so you don't have the same potential. And you have to be more on your toes. You have to take trades usually earlier because there's less room to maneuver. So completely the opposite when we have high volatility, where it seems like you have all the time in the world. So again, one of those things that's counterintuitive with a pro way of trading versus a retail way of trading. When we place our trades, we're placing them just outside of the expected move. Now, we're not consciously looking at expected move and then placing our trades there. That's where they end up based on the risk to rewards that we put on. So when we put on our standard maximum debit for a butterfly, which is 10% of the width of the fly, so in other words, a 30 wide fly, we're going to pay $3. That naturally gives us a 1 to 9 risk to reward, and that typically will push the fly out so that the expected move is actually just inside here. If you were to, let me get my annotation doohickey out here. A 1 to 9 would actually put the fly right about there, right? And this one right here would be more like a 1 to 15 or a 1 to 18. It's further out. You might think that, hey, I'm going further out. Is there less chance of me making profit? And the answer is no, there isn't. That's really another counterintuitive thing. In fact, not only is there not less chance, but the amount of money that you make for the risk that you put up is significantly more by pushing the trade further out. Do the math, inspect it yourself, use your Thinkorswim, do the modeling, and then prove it to yourself. And you'll find that going further out and wider actually works better, even though in your mind's eye, you're thinking, man, this is further out. I'm never going to make any money. But for the same exact move, further out and wider makes you more money. All right. I need to squish this, turn it off, and go to the next slide. When do we start thinking about taking profit? typically not until we've achieved about 75% return or unrealized gain on our risk. So let's say we put up $100. We're waiting for the unrealized profit to get up to about $75 before we start managing it. And that's pretty normal for us. Otherwise, we're just waiting for that opportunity. If it goes against us, we don't manage it. That's a key. We don't manage it. That's important. I know it sounds crazy, but we've already defined our risk. That's why we don't manage it. Remember, we flipped the script from risk management to profit management. So we wait for it to get to about 75%, and at that point, we have about a 75% dynamic trail. What that means is that we're willing to give up 75% of that profit that we've made. So if it's $75, we're willing to give up down to about $20. So we set our stop at $20, and if it gets down there, we get out. If we get another opportunity to get in, we'll get in. But as long as it stays within there, we'll stay with the trade. And if it keeps on growing, we keep on adjusting that 75% stop until we get to about 11 o'clock in the afternoon. I'm assuming in the morning. I'm assuming that we're taking this early in the morning. And we get a little later, and now that dynamic stop has shrunk down to about 50%. And then we get to the afternoon, it shrunk down to about 40 or 30. We get further into the afternoon, and it shrunk down to maybe 25%. At that point, you can really use we would assume that you would be inside the profit tent, and if you are, you could use the profit tent as your fold indicator. So if you hit the profit tent or go beyond it, then you get out of the trade. If you stay within it, then you stay with the trade. And that may get you out of some trades what you consider early, but it will also allow you to capture those bigger trades that are the ones that you never achieve. And this will give you the kind of returns that you're looking for. So this is illustrating how our dynamic trail is slowly diminishing as time goes on. It's really not linear. It's more, I don't know, if I had to draw it, I would say that it looks more like, I don't know, like this. And then at some point we just use the inside of the tent. So this is the percent trail either side. And once we get further on into the day, here's noon, it starts closing even more. And so in other words, we're much quicker to take profits. Because at this point, if you're out here and you're in a trade, the likelihood is that you've got about 400% return on your hands or more. And who wants to give up that 400%? So in other words, you might beat up like $1,500, $2,000, and you're not going to give up more than 25% of that, right? If you're up $2,000, who wants to give up more than $500? But at that time, the profit curve is very steep, which means gamma is very high, the sensitivity to your price, and a small move could easily drop $500 or even $1,000 off of the gain that you once had. So that's why as the day goes on, you have to shrink your stop and the amount of space that you're willing to give it. Right? And as long as it stays in there, you stay with it. Because what could happen is if it stays inside there and there's nothing going to throw you off that trade and you can get a pin trade, then you could get a return of 1,000, 1,500, 2,000% depending on what risk that you took. All right, let's get rid of that. Moving on. Almost there. Let's see what time we got. All right, got a few minutes left. Tight convexity, hands on the wheel. So again, we start at 75% and then we slowly diminish that. It constricts hourly, so this is a review. As we go further and further into the day, that opportunity is closing. In low volatility regimes, that opportunity closes faster. In high volatility regimes, it closes slower. But we want to essentially take it before the close for the most part because risk, although there have been occasions, I've had at least maybe a dozen trades where I've waited right into the close and let the close take my trade and made unbelievable profits. But that it doesn't happen that often. It happens more when we're in higher volatility regimes, believe it or not. Generally at 3 p.m., if you're still in a trade, then you've already achieved about 80% of the maximum premium you could ever collect. And man, that's usually a pretty good trade, usually around a 700-800% return. And who doesn't want to take that? I would take that all day and feel good about it. All right, we are right here. All right, this is the next one. Set the rules, let the theta work. What I'm going to do is I'm going to put a link down below where you can download this presentation. Don't worry about it. I know there's a lot of information here. You'll probably want to go back and study it, but it'll be there for you. All right, so we're talking about, this is a little bit of a confusing slide, but it's talking about all three of our strategies. So I'm not going to try to explain it right now because it will take some context. Same here. Let's go to this. All right, so this is showing the various categories of trades that we have. The single out-of-the-money butterfly on a 0 DTE day is very active. Convex stack, which is a little further out, talking about 3 to 5 days DTE. It's more deterministic. We're looking really for other types of structural events and structural levels to get us out, or looking how gamma is affecting our trades. But the fact is that we're still further out, and depending on where volatility is, we may be sitting on a trade that has 300% return, but we still have 2 days left. Do you stay in that trade? That's a tough question, because you could be sitting there with, I don't know, several $100s worth of profit, and you're wondering, I've been in this trade for a day or a day and a half. Should I take it or should I wait? Generally, it would really depend on a number of things. I'd have to start doing a structural analysis. I'd have to look at where gamma is. I'd have to look at the trend, where we are in a volume profile structure, that sort of thing. Are we in a consolidated zone? I might be more apt to stay with the trade. Are we in a low liquidity zone? And then I'd probably be more apt to get out of the trade. That sort of thing. Sigma drift is a little bit more different. It is different. Convex stack is deterministic based on that analysis. Sigma drift is longer term, and it really comes down to what day are you in profit, because it's going to change. So you might miss days 1 through 8 and not being in profit. Then all of a sudden it jumps into your profit tent or close to it, and you're sitting there and you paid $80 for the trade and you're up like $800, $900. Damn. That happens on that one day, I'm out. That's what opportunistic means. And that can happen on any one of the days leading up to the day that it's going to expire. So we're more opportunistic with these longer term trades. We monitor them. You'll have plenty of time to get in and out. But if you find yourself with a big move on one day and all of a sudden it's the third day out of an 8-day trade and you're up 300-400%, and you're thinking, yeah, but I could make $3,000 if I held on. Don't think that way. Take the damn trade and be happy. I don't see how anybody could be not happy with a 300-400% return. All right. It's hard to tell on this where we are. Let's see. Oh, this is slide 18. We're right here. No, that was slide 18 here. And okay. Now I'm getting it. All right. Now, remember I said that volatility is all about the rate of premium decay. And there's going to be different situations when you have low VIX for a trading session versus high VIX in a trading session. And so what I'm showing here is where opportunity lies in low VIX, and we're approaching that low VIX, versus high VIX. On the right-hand side, the opportunity expands. So I'm not saying that's the only place where your opportunity, I'm saying that's the prime place where you're going to take most of your trades. And so because of rapid premium decay and low volatility, that range is much smaller. In high volatility, that range expands. Again, one of those counterintuitive things. All right, common mistakes. Mistake 1, holding too long. And I've been beating that dead horse, right? That holding too long with hope that you're going to get a much better return by just waiting around, and you're on the edge of the precipice. You've made good profit, but a small move can ruin your day. But you're determined to hang in there because you haven't gotten that big return yet and you want it. That's dumb. You have to assess the risk objectively. And if the risk is too high, if the market's been moving, just get out. Just get out. Take it and be happy. On the other hand, I think the getting out early, we're saying taking 25% gain because you got nervous, then watching it run to 300%. And that is really something that you get over time. And that is some of the baggage that we have to deal with when traders first come in, because they're so used to managing risk and they're hypersensitive that they see a return and they want to take it. And so they get out real early and then they miss it and just avoid or ignore our profit-taking management rules. And so they'll get out. Over time, you start getting over that. But it takes a while before you can shed all of that baggage. And I understand. And that's what will help you do. All right. Let's see. Don says, I have fallen into this habit of buy 2 contracts I use if I have a profit on one is greater than the total cost of the 2 contracts. Then I trail stop 1 contract and tend to let the last contract run. Yeah. And I guess the idea is playing with the house money, right? But if you had held both of those contracts and you went into that deeper run, you would have made a lot more money. My experience is that you can do some of that scaling in, scaling out stuff when you have a much larger account. 2 contracts, that's really not giving you the kind of opportunity that would allow that. So I would say with 2 contracts, I wouldn't be thinking scaling in, scaling out that much. I would just look at that as your natural scaling according to your account size. In general, I like to either all in or all out, unless I have a pretty big position. And I'm trading with a fair amount of money, so I might put on 4 or 5 positions. I might consider taking 1 or 2 off and letting the other 3 ride. But with just 2, that's a tougher decision. All right. You follow this. And this sort of gives you the bird's eye view of the strategy, whether to hold or fold. And now we're near the end. I didn't think that we would get all the way down here. Oh, 6 rules. Tape them to your monitor. This is really good. So I recommend that people that are trying to develop a routine, put these routines out there, because each one of these steps is part of your trading routine. There are 3 basic categories that you're looking at during the trading day. You're looking at your preparation, your execution, and your reflection. So those are your 3 main categories. Within each one are a series of habits that you're trying to manage. And that's what this is trying to show. In your execution stage, there are these series of habits that you're trying to manage and perfect. And so write them down, put them up there, and then grade yourself as you're going on, and then journal that experience. Want to learn more about that? Go back to a previous episode where we talk about journaling and reflection. All right, Dave's saying, when you say trail stop, do you do that manually or set an actual trail stop order? I personally do it manually. You can do the trail stop order, but there's no guarantee that it's going to fill where you want it. And you'll find that unless, you want to not attend to your trade, in other words, you don't want to maximize the amount of profit that you could get, then set the automatic trail stop. If you're that type of person that can't keep your attention to the trade, then I'm not sure why you're trading. But if that's the case, then set the trail stop. You're going to, more often than not, get stopped out too early. So I would say that from my experience, this is a discretionary strategy, meaning that you're not letting automation take over, and you will maximize your profit potential. When you start automating, you start tending towards the worst case scenario. Do it if you'd like. I'm just telling you my experience. If you go into any of the big brokerages, you'll see that there's 2 main guys. There are the auto traders, and then there are the discretionary traders. And the discretionary traders consistently make more money than the algorithmic traders. There's a reason for that, because the human brain is better than any algorithm that you can come up with. So that's how I would treat it. All right, there it is. If you have more questions, put them down below in the comments section. Please give this presentation a thumbs up. I only see 12 thumbs up. Darn. Come on. Let's see those thumbs up. Come on. I want to see them go up. Click it now. This is super dense material. Like I said, I will put the presentation in the description. And take your time, go through it, keep it. You're going to see that this is going to make a material difference in your trading. assuming that you're trading a pro way. And if you're not, then go to flyonthewall.ai/try, become a member, and we'll show you how to become consistently profitable, independent, and trade at a pro level. All right, so back to the big head. Hold on. There we go. I wanted to do the side view because I love the side view. Yeah, there's the side view. See, there's the presentation. Again, thank you very much. Hope you have a great rest of the week. We'll be back on Monday with another 3-day presentation. Everyone will have a presentation like this, and I'm just starting the presentation part and including the links. That's a new thing that I started this week. So if you go back to previous weeks, you won't see the link, but I'm going to start including those now. I think that having this type of material here is a real help for people. You'll get this kind of treatment and more if you join the service, because we have a Discord channel. We have a fantastic application where you can do all of this analysis. And you'll have direct access to me and other traders that have been trading this strategy for a long time. All right, it's a great deal. All right, so now we go here and say thank you very much. I hope you all have a great rest of the week. I have to call my wife back now. She's in Italy. Take care. Peace.